Some of the most traded indices in Forex are the DJIA, Dow Jones Industrial Average, also known as Wall Street or the Dow, comprising of 30 of the largest US companies, the Standard & Poor's 500 or S&P 500, comprising of the largest 500 companies listed on NASDAQ and NYSE, NASDAQ 100, comprising of 100 of the largest US tech companies, the FTSE 100, comprising of 100 of the largest UK companies, and finally the DAX 30, comprising of 30 of the largest German companies. Indices allow you to trade the whole market instead of a single security. So when you trade an index, you are speculating on the collective performance of all the companies that it has. A CFD or contract for difference allows you to trade an underlying asset without actually owning it. For example, when you buy a Facebook stock, you become a shareholder of that company. You have an exclusive right to ownership, you can receive dividends, attend annual meetings, and so on. But when you buy a Facebook CFD, you don't become an owner as you do with buying a stock, and that's the only difference. A Facebook stock has the same price as the Facebook's CFD. They are mirror images. So buying a CFD allows you to speculate on the price without actually becoming a part of the company, as you would with a stock. And that's all CFDs are. CFDs developed in the 1990s and account for almost 20 to 40% of the London Stock Exchange volume. Now let's come to ETFs. An ETF or exchange traded fund is a collection or basket of securities. For example, let's say you're very optimistic and hopeful that the energy sector will perform very well in the future. So you buy an ETF that is made up of a basket of securities from the energy sector. So now your ETF performance depends on the collective performance of all those energy securities. That's all an ETF is. It allows you to trade a wider sector rather than a single security. ETFs have been trading in the US since 1993 and Europe since 1999. More than $2 trillion worth of US ETFs have been traded between 1993 to 2015.